Welcome to Trillions. I'm sure this is the first time, or probably the first time, you've heard of us. So I'm going to make this introduction quick. But hopefully there's a lot of value in this presentation and video. My goal is that you are prepared to start taking trades with me for free every day. I go live for free. Just starting to do that this Monday, March 6th, 2023. I've been doing tons of background work and in building trading algorithms and an automated trader for the last 6 months, and we're getting ready to take that out in the next probably 3 to 6 months, just wrapping up all the tech and infrastructure and legal aspects. But I wanted to start delivering value right away, and I'll get into all the whys, etc. But I just felt like I wanted to deliver value right away. I wanted to help people make money. Maybe they weren't ready for an automated trader or some of the other things that we're going to do. And I just didn't want to wait any longer. And honestly, I was disappointed with a lot of the offerings out there. Too expensive, just so many challenges. Anyway, by the end of this video, you'll know if options trading is for you. I hope you feel confident that you can execute trades with me or another expert you trust. You'll know how to open and close trades to avoid all of those early trader mistakes. And you'll be off and running, turning $50 to $100 in small investable capital into hundreds of dollars in profit every week. So let's jump into it. In this video, we're going to run through two things: how options work and how to execute options trades. My goal for the how options work section is that you understand options trading and you feel comfortable enough to feel like you can trade options, that it's not as confusing as it can be when you watch some of these other videos, or you might read a post that you found through searching. Also, if it's a fit in terms of your budget, your schedule, and your goals. And we go through a few things: what's an option, how do the option contracts work, and the big FAQs to see if options is right for you, as well as the pros and some cons of options versus buying and holding. The second part is the little things you need to know to be able to open and close options contracts without errors. Again, whether it's with me or another expert that you trust, really want to eliminate those simple things that later on in your trading career, if you stick with it, you'd say, wow, that was so simple. Why did I make those mistakes? But people make them, so I want to save you those headaches. So I run through the terms, terminology, and visuals on how to open and close trades, some of the best practices for which order type to take, and then also some best practices in terms of selecting options expirations, strike prices, and also times of day. So I want to introduce you a little bit to Trillions. You can skip this if you want. It'd probably take about a minute, but it's important to me. My why is, when I thought about Trillions and what I wanted to achieve, I wanted to make it accessible to anyone with as little as $1 to start. And for me, accessible meant true financial freedom. I broke that into like how I would execute my days and a long-term vision, where phase one is day trading to level up income through options, futures, and equities. We're going to start with options first, initially through some of these free signals. And then by end of 2023, we will have that automated trader and algo ready. And then the next is like portfolio rotation, dividend investing. Again, that will be for free through videos on YouTube to start. And then probably early 2024, we'll launch the automated rotation through a fund structure. And then on the back end of that, once you have an income source that's driving meaningful income, a passive income source through the portfolio rotation, now it's time to start looking at assets that provide tax benefits as well as income at the same time, such as real estate and banking. My why is pretty straightforward. I come from basically like nothing. We live in a decent neighborhood, but like I was the kid that was wearing $1 shoes while other kids were wearing, the Air Jordans. And I just remember how that makes you feel about yourself. And then as I made my way into the world and professional world, regardless of education, I still saw how many people just weren't exposed to the foundations for, like, not even financial literacy. It's like a step beyond that, but understanding what it means to create wealth and whatever path that is for you, whether it's owning a corner store in the building that it's housed in, or options trading, whatever it is. It's like really understanding the language of wealth creation and realizing that there are many ways to break those barriers. So as I mentioned, after getting my degree and playing out in traffic, and I just got tired of the nonsense on CNBC, 10 different people with different opinions, like really tired of the fool.com and the rest of these sites with the top 5 stock bait and switch bullshit, excuse my language. And then also, as I spent the last couple of years really diving into the day trading and the programmatic side of it, um, I just I've spent a lot of time in different discords and watching traders, and there are some really amazing people that want to help a lot of individuals. But there are also a lot of individuals that just want to flash their Lamborghinis and make millions of dollars, not really caring whether the people in their communities are successful. I just got tired of all of it, right? I mean, the people I'm fighting for, the people I created trillions for, it's the people who have the jobs. We're like, we've all seen the person that works at like the corner store, or maybe at a drive-through we've been through, and we're like, you feel sorry for that person because you believe you see in them almost like they've already given up, like that is the best job they will ever have in their life. And I want to create financial freedom for them and an alternative path. So many of the people I lived around and worked with when I lived in North Philly and some of the worst areas in New York too, that like are in extreme poverty where half of the block is burnt down, there's drugs everywhere, there's violence. They're like giving them a different and real path. And then the last is the individuals who are putting their lives and time on the line for us every single day as teachers, police, military, firemen, frontline healthcare workers, the volunteers in these like frontline nonprofits. And none of them have any sort of financial security or stability ecosystem or structure put in place. That needs to change. So let's jump into it. How options work. Strike price, that's the price you agree to buy or sell a stock. So let's say you want to buy Tesla for 190. That is the strike price. The price you are willing to pay for the right to buy Tesla at 190 is the options premium. So I want the option or right to buy Tesla at 190. I'm willing to pay $1 for that. $1 is your premium or price. Price is how you'll see it in the apps that you're trading. Expiration date is how long you have until that right expires. It can't be forever. So I pay $1. The price I'm willing to pay is $1 for the right to buy Tesla for $190. And I have until, let's say, Friday, March 10th to take advantage of that right. A put is used when you expect the price to go down. A call is used when you expect a price to go up. What a put does is it gives you the right to sell a stock at a certain price. Let's use Tesla again. Tesla's, let's say, at 190. You think Tesla's going to go down to 180. You want the right to sell Tesla at 190, and you're willing to pay for that right. That's how you'd use a put. Tesla's at 190, you think is going to go up to $210. You are willing to pay a small price for the right to buy Tesla at 190 because you think it's going to go up to 210. An option is a contract between two people, the buyer and the seller. The buyer has the right, the seller has the obligation. I'm going to say that again because you don't want to be the seller. You want to be the buyer. That's where 99% of the day trading you see in the discords and the daily traders, it is all about being the buyer, not the seller. Because the buyer has the right, not the obligation. That means your maximum risk is the premium or the price that you've paid, whereas the seller has the obligation. And I'm going to get into what that means in the next couple of slides here, so let's keep moving. A little bit deeper on how contracts work, just because there are a couple of other questions, so you have a foundation. The contracts are for 100 shares. So every contract you buy, you have the right to buy or sell 100 shares. That 190 that you want to be able to buy Tesla for, you paid $1 to be able to buy Tesla for 190. Well, the way options contracts work is they bundle the right to buy 100 shares, which means it's $100. You have the right to buy 100 shares of Tesla at $190. They cost you $1 per share. You pay $100 for that right. Buy to open is a way to open a contract where you are saying digitally, obviously, I want the right to buy or sell this stock at this price by this date. You want the right, not the obligation. You buy to open. The seller is selling that right and creating the obligation. I'm going to reinforce these things multiple times. Be the buyer, not the seller. To exercise an option means you want to take advantage of that right as a buyer. Tesla goes up to 210. You bought it at 190. I want to take advantage of that right. I want to exercise my option. I want to buy those 100 shares from you at $190. I know you have a question. We're going to answer it in a second, which is, what if I can't afford to buy 100 shares of Tesla at $190? Don't worry. You can sell your option. And this is what most options traders do. You sell that option to someone else. So simplified, you buy the right, you buy to open the right to be able to buy Tesla at $190 for $1. Tesla goes up to 200. Keep the math simple. You have the right to buy 100 shares of Tesla at $190. You paid $100 for that right. Tesla's now worth 200. Your options contract is now worth $10, right? 190 to 200. You sell that to someone else. You paid 100. You made 900. Somebody paid you $1,000 to take that right from you so that they can have the right to buy Tesla at 190. Here are a couple of FAQs. We just talked about this one. What if you can't afford to buy 100 shares of stock? I just gave you the example of how it works for Tesla. Yes, you can sell your shares to someone else. I cover that quickly. You can either exercise your option or sell your option to someone else. Those are the only two ways to exit out of your option. And then the final question, which I've heard quite a bit, is what if you want to buy just 5 shares of Tesla through this options contract? And you can't do that. Unfortunately, it's all based on 100 share increments. If you bought 10 contracts and you had the right to buy 1,000 shares of Tesla, let's say a year from now, you can afford to do that. You can sell 9 of your contracts or the right to buy 900 shares to someone else at a profit, and then exercise your right for one of those contracts so that you now own 100 shares of Tesla at a discount. That you can do. You can take like one of your contracts and treat it differently than the other, but you can't break up the 100 shares in the contract. Let's get into an example. Now, the example I'm going to use is for a symbol that and strategy that's used for the majority of day trading. So SPY and QQQ are where the majority of day trades happen with options traders. So let's assume it's a Tuesday. And based on my analysis, I'm looking for a trade that delivers a profit when the price of the SPY ETF goes down. The current price of one share of the SPY ETF is $400. My trade is confirmed at 9:45 a.m. Eastern, and I buy to open one contract with a $397 strike price for today's expiration. The price I pay is 50 cents per share for a total of $50. Well, let's go through the 3 scenarios. Let's say you're the buyer and I'm the seller. So you buy that one contract for $50. The price of SPY goes down to $396. The value of that one contract is now worth $1.50 per share, or $150. You sell to close your contract at a 200% profit. You sell it to someone else. Now they have the right to buy SPY at $397. I'm sorry, sell SPY at $397, just a put, if they'd like. As the seller, for me as the seller, I keep your $50, right? Right now, I'm keeping your $50. I've made a $50 profit. However, if the new buyer chooses to exercise their option, I must buy 100 shares of SPY from them or you. If you choose to exercise, I have to buy it from you. If the person you sold it to chooses to exercise, I have to buy it from them. I can sell those shares at a small loss of $1, or I can just hold on to SPY because I expect it to go back up. The only thing I get to do at this point is keep the $50 premium. But you can see that there's a big potential risk here. If the price of SPY goes all the way down to $390 and I don't own those shares, now instead of losing $1 per share, since I have to buy it from you at $397, now I lose $7 per share. I lose $700 on one trade. Imagine if you opened 100 contracts with me. That's why being the seller is risky. Let's say the price of SPY stays around $400. You're the buyer, I'm the seller. The value of your contract, if the price stays the same, is going to go down a little bit as the day goes on. Why? Just because there's less time. Like, think logically. If you have until this Friday to exercise your right, wouldn't you expect that that right is worth more today than it is, like, say, Thursday? Because there's more time between now and Friday for your desired result, right? Versus Thursday, you only have one day. So there's less value because the probability is lower. The chances are lower that you're going to hit a price that's going to make your contract profitable. So here is a situation where if the trade does not turn out the way you want, as the buyer, you recognize it early, you sell it for a small loss, you sell to close your contract to someone else at $40. And you might say, wait, someone else is going to buy my contract even if it's going down? Yes. And it's like just simple, hard, yes. That's why we only trade certain symbols, because there's always enough volume to get out of your trade and keep your losses minimum. So you lose $10 on a trade that went against you. As the seller, I keep the $50 premium paid. I'm not required to buy or sell any shares of SPY for this options contract. If the price of SPY goes up, which means the trade goes against me, it's similar to if the price stays the same, except the value of my contract is going to be even lower, because the further the price moves from my target price, my strike of 397, the lower the likelihood or chance that it actually gets to 397, and that's what I need for my trade to really be profitable, to move in that direction. I don't need it to reach 397, but I need it to get closer to it. So I recognize the trade's going against me. I sell it for a small loss at $35. So I lost $15 on that trade that went against me. Again, as the seller, I get to keep the $50, or I'm not required to buy or sell the shares of the ETF. Next example is a call, QQQ. The price of QQQ is at 300. I expect it to go up. At 9:55, I buy to open one contract with a 303 strike for today's expiration. Same cost, let's say 50 cents per share. One contract, it's $150. All three scenarios, the price goes up the exact same as it would work as the put. For me, the value of my contract goes up. I just sell it. I take my profit as the buyer. As the seller, I can keep the premium as long as the buyer doesn't choose to exercise their option. If the buyer does choose to exercise their option, then I have to sell 100 shares at that 303 price, right? So this is where the risk comes in. If I don't own the shares and I have to sell you those shares for $303 because your option is at 303, and the price of those shares, let's say they're at 310 or 320. Let's say QQQ really goes high and it's at 310. Again, I lost $700 because I have to sell it to you at 303. But if I don't own the shares, I've got to buy the shares to sell you. I have to buy them at whatever the market price is. That's why don't be the seller, be the buyer. So if the price stays around 300, very similar to as a put, the value is going to go down as the day goes on. You sell at a small loss. As the seller, you keep the premium. Same thing if the price goes down and goes against the trade, the value is going to go down. You sell at a small loss as the buyer. The seller gets to keep the premium. So I know you've got lots of questions. Let's jump into these, and I'll take the most important ones, and you can screenshot this if you'd like. Most people ask, how much do you need to start? They say 2,500. Honestly, with the way I'm trading now, and I look back at how I traded before, I think it's better to start with less. Like, you can have more and say I have 2,000, 3,000, 5,000. The problem with that is you'll tend to risk more in the beginning before you know what you're doing. I think the best is you start with a very small amount of money. Honestly, you could start with as little as $100 to $200, but it's nice to have at least 500 to 1,000 because it gives you, I think it puts less pressure on the trades. And the other advantage, again, I'm going to say is that, like, look, if you only started, some people say you need 2,000 to 3,000 to start, but these trading communities, it costs $200 to $300 per month. I mean, there's so much pressure to start trading, whereas we're free for a reason. so you don't feel the pressure. You can start with $500 and just not trade for 2 weeks. Just follow along, simulate the trades, learn as you go, and then you start to trade as you get comfortable. So that way you're not risking as much as you would if you join these other communities and feel the pressure to trade. One contract, as you can see, those were real prices for QQQ, and you'll see in some screens later on. The typical contracts I'll buy in the morning, same day expiration, they're only going to be like $40 to $50. You don't need any experience. How much can you realistically make, even if you only started with $50 a day to start? The reality based on like, there's typically 2 good trading days per week, non-Fridays. And then Friday, especially during earnings season, you'll usually have one or two stocks with great catalysts. And that's where you get like a 300 to 500% potential return. So on the 2 good trading days, you'll get like 40 to 50% on the trades. So maybe you make like 20 to $25 Monday and Tuesday, let's just say. So you make $50 those 2 days with $50 investments each day. And then Friday, you might make 100. So you can legitimately make, 100 to 150 a week, maybe more, with just $50 a day to start. When do you need to be available? The best times of day to trade consistently are 9:30 a.m. to 11 a.m. Eastern time. And it tends to be closer to 10:30 a.m., like 9:30 to 10:30, but around that time. And then, 2 o'clock to 3:30. You don't need to be available. Ideally, you're just able to receive an alert. I live trade from 9:30 to 10:35 or 10:40. And then if I see something else later in the day, I will send out alerts. And that alert system is going to be set up this week as well, if you just wanted to get text alerts. Can you trade from your mobile phone? Absolutely. How long will it take to be successful on your own? Honestly, let's get into that in a later discussion. There's a lot that goes into that. With others, I can't speak to that for the same reasons I talked about earlier, in terms of like whether they know what they're doing or whether they're great instructors. Can you trade options in your country, whether it's TD Ameritrade or Thinkorswim, which is the same company, or Interactive Brokers? They're available in many countries worldwide. So the answer to that is most likely yes for U.S. securities. I'm going to skip the rest of these just because they're not. We already talked about buy to open. Yeah, I mean, the only other question you might ask is like, how can the price of an option be worth more than the price plus the stock difference? Like as an example, where I said the value of the stock is 396, or sorry, the value of the ETF is 396, but the value of the option to be able to sell at 397 is 150. It's the way it works when a stock moves quickly. The numbers don't always add up. And this is where like expiration date comes into play. We started to talk about this already. Like the more time you have between now and the expiration, the better better that return is going to be. So I wish I could just give you a formula. All I can say is it does work. Pros and cons of options trading. Most of these are pros. Honestly, you can profit in any market condition, and there's no downside risk when you day trade. So let's say, a report comes out tomorrow morning and the market collapses 8% in the next 2 days. It doesn't matter. You're not in a trade. Not only does it not matter, you can make money on those days. You'll have to make more money on the red days than you will on the green days. So you make money in any market condition. You have no downside or overnight risk. Exponentially higher return. Exponentially higher. In the last 3 years, Tesla stock went from $50 to $400, down to 100, then up to 200. If you timed every one of those tops and bottoms perfectly, you would have turned 1,000 into 13,000 over 3 years. Trading options over on Tesla in the last 12 months, and I've been doing it, so I know what all the trades are. There were more than 60 opportunities to cycle through that $1,000, and there were only 2 losses. Several of those trades, and by several, there are at least 5 that I remember, and I have to look back through all the data, that were 10x returns. So, but I'm just going to leave the rest of them at 100% return, because some of them were 40 to 50%. So cycling through that $1,000 just over the last 12 months using options, instead of 13,000 over 3 years, it's 58,000 in 12 months. There's just no comparison. The only risk you have is the premium. And if you're smart about cutting, and this is where trade management comes in and what I get into in the next slide, then you're never going to end up in a situation where you're blowing accounts. People who are blowing accounts they're jumping in, they're not learning, they're gambling, and honestly, that's where those horror stories come from for me. And I think a lot of that comes from what we see. It's like we see people driving Lamborghinis, we jump into these communities, we're paying $200 a month, which is 10% of our total, available capital when we start, and all of a sudden we feel rushed to do something we need to take time to like really get into and get good at. So let's jump into it. How to execute options trades, right into it. This is a TD Ameritrade mobile view foundation. You should understand basics of how options work, strike premium. Now we're going to reinforce it all and show you. So here's a screen. This is the screen where if you look up at the top, you see chart, news, rating, options. So it's very easy to like go from QQQ, jump into options. Now what do we see? Here are the calls. That's where you select the calls. That's where you see the puts, right? See how you see on the left and the right are the puts, the left columns are the calls. Next is the expiration date, March 6th. Really easy. Okay, if I collapse that, I'll see additional expiration dates. The next is the premium or the price. The price that I'm paying is $1.02. Okay, so I'm willing to pay $1. I can see that. I got it so far. There's a call for March 6th, and it's $1 for the right to buy QQQ for $301. And there's your strike price, $301. So you have a call expiring March 6th with the strike price of 301. I have to pay $1.02 for the right to buy QQQ for $301 by the end of day March 6th. With me so far? Great. Here is another example. And by another example, what we're talking about, just to go back, this is selecting. So let's say I select that and I want to enter a contract and I'm ready to buy, right? So it's like, great, I'm ready to buy. I've selected the right options chain. Now this is the screen where you're actually entering the trade. Buy to open. Remember, buy to open only. Make sure this is right. You don't want to lose your shirt. This is where you're going to lose your shirt. Slow it down. Options premium or price right here, the bid and the ask. See, we've got it right here. And this is the actual cost. 3 places out of the money, 42 cents. Expiration date is today. If I would have selected a different date other than March 6th, which is the next expiration, so technically that's today, it would show, let's say, March 7th or March 8th. So we're going to look at a market order. Right now, this is what a market order is. Market order means you are paying the ask. The ask is what someone is willing to sell one option contract for. So market order, it's in blue with intention. You're paying the ask. 42 cents is the ask. One contract is going to cost you $42. With me? 42 is the ask. That's what someone is asking to sell to open the contract. You're like, yes, I'm willing to pay $42 to buy to open the contract. I want one contract, which gives me the right to buy 100 shares of QQQ at $303 before the end of day, March 6th, and that's going to cost me $42. Another way I can open is a limit to say, I don't think it's worth 42 cents. I think it's worth 40. The limit I'm willing to pay is 40 cents. I still want to open one contract. I'm willing to pay $40 for this total for the right to buy 100 shares of QQQ for $303 by the end of March 6th. With me so far? So you have a market order, which is I pay the ask, which is what somebody's asking for. I have a limit order, which is this is the maximum I'm willing to pay. And I can submit my order and you can see that there's a slightly different price. They're both buy to open. Now sell to close. Once you're in a position, and I open a couple of penny stock positions here just to show you, because I don't hold any of these positions overnight. You click on it, you'll see your positions. You click on it, again, this is TD Ameritrade. Click to close, it'll open the screen. Sell to close. See that up in the upper left-hand corner? Sell to close. Make sure that that's what you click. Make sure you don't, by accident, click something else. You have sell to close and the market order. The market order, again, is you're selling, like here, you're selling at the bid. Right now, you're selling all 6 shares. The bid is 0, which means you get $0. There are no bids. Nobody is willing to pay anything. They think that this options contract is worthless. You're stuck. That can happen, but It rarely does. And I will create another example with an open contract this week so you can see what it would look like with QQQ. But more often than not, what would happen is you would see, as an example, you would see the bid, if this was QQQ, the bid would be 40 cents and the ask would be like 43 cents, and then the numbers would be adjusted. A stop market. Now, the way a stop market order works is you want to sell your contracts when the price of the contract gets below a certain point. And this is how you really put in a stop loss, right? Let's say you paid 42 cents for, or 40 cents for the QQQ contracts. And if it gets below 35 cents you want to sell, you put in a stop market. What a stop market does is I want to sell 6 contracts at the price I've selected, which is a total of 600 shares at 10 cents for $60. So let's get into some best practices. These are just the things, honestly, a lot of them I wish I knew when I started. And I think everyone probably wished they knew when they started. The best time to, how to use a market order, you're agreeing to pay the ask of the options contract. And we already talked a little bit about how that works. Basically, when you buy to open a market order, whatever the ask is, that's what you're paying. When you're selling to close, you have your market order, which means you're agreeing to pay the bid, whatever that bid price is. You have a stop market order, which is where you put in a specific price where you want to sell. There's a stop limit order as well. The problem is stop market means when it hits that price, sell everything at whatever you can. That's the market. Stop limit means if it hits that price, sell at that price. The problem with that is, imagine if it goes to, let's say your stop loss is at 35 cents, right? Because if you see that, that means the trade is going against us. So you want to sell 35 cents, but you put 35 cents in as a stop limit and the price just keeps going down, you're never going to get out of your trade. So instead of having what works out to be about a 15% loss on your trade from 40 cents to 35 cents, you end up realizing a 30, 40, 50% loss. So that's why you do a stop market. Some of the other major questions, again, these are the really wish I knew, the best expiration date to pick. If it's before 10:15 a.m. Eastern time, use a 0 day to expiration or today's expiration. If it's after 10 a.m. Eastern, use the next day expiration. And the reason I say that is there isn't going to be volume. You often get into these choppy periods, which means the value of your contract is going to just slowly die. And even if the price moves, because there's less volume, it's not going to move as much as it would in the first 45 minutes. So having that next day expiration means you have that extra time for this price to move in your favor. So even if it's a slower move and it eventually reaches your target price, you're going to profit, versus if you reach your target price, but you reach your target price today and your expiration date is today, and that you reach that 20 minutes before the day ends, you're still going to lose money on your contract, right? Just because it's you paid 40 cents to be able to buy QQQ at 303, right? But it's 3:45 in the afternoon and QQQ's at 301.50. Your options contract's not going to be worth anything. But in the morning, if QQQ goes from $3 from 301.50, your options contract is going to go up 40 to 50%. You'll be able to see that. Some of these things you just need to experience. So just join me a couple of days free live. I'll talk you through all of this. You'll see it. It's hard to get a lot of this in these videos, but I wanted to give you a foundation so you understood some of it. So it's not like you're hearing this language for the first time. Which options chain to pick? Never more than three places out of the money. I always pick 3 places out of the money, mainly because it gives the right balance of reward and low entry point. So if $300 to go back up, give you the visual. I should have included. So right here, if 301 is your at the money, 303 is, I'm sorry, 300, 330. So this is your at the money, 303. There's 3 places out of the money. That's the way I think about always buying contracts, because the value it's going to, the amount you're going to pay and the value you'll receive Do not go any further out because it's just, these don't move enough, and I'll explain why later. I'll explain these on the lives. It's just a lot to digest in one video. So now we need to speed through all these. Yeah, I should have created that image on this page, but whatever. When to sell a winning trade. Honestly, I get into this, but you want to sell as you're approaching a key resistance level. When to sell a losing trade, when clearly your trade is invalidated. This is why levels is everything, because honestly, when you enter some of these momentum or continuation trades, it just goes against you too much, and you end up in a situation where your probability of loss is your probability of loss is too high, your emotions are running high, and you're not really sure of like what an invalidation looks like. Honestly, there's only one way to really understand it, and that's to see it consistently, which is why I'm doing this for free as well. We already addressed whether I can't afford to buy 100 shares of stock that you pick, but it's something that comes up so much, so I left it here. That's trillions, around about 35 minutes, longer than I wanted. Everything is timestamped below in the video. Also, you'll see my LinkedIn to connect with me and learn more about me. You'll have more information. You have the agenda and timestamps here. You have the ability to sign up for our daily lives. It's all free. Like, we're not asking for anything. There's no money, any of that, no friction, no like pay later, free trial nonsense. It's all going to be free here. There's also a couple of ways to contact me if you have follow-up questions or something you want covered. Other than that, like, hope this did provide some value. Hope this created some clarity. Share it with anyone you think it could be valuable for. And then I look forward to seeing you in the mornings.